QQQ, SPY, or DIA. Which of these three ETFs gives us the most advantage in the long run? How does market timing impact the long-term returns for these ETFs? And which of these ETFs has provided the best return after a recession? To answer those questions, we're going to review the total return for a $1 million investment in each of these three ETFs. We're going to use different starting points, both before and after recessions, over the last 26 years. Let's take a look. Here's the long-term view for SPY, QQQ, and DIA. We start with $1 million, January 1, year 2000. December 10, 2025, we've got 7.9 million in QQQ, which is out in the lead, 7.3 million in SPY, 7.2 million in DIA. Now in the long run, QQQ has pulled ahead. But take a look at this period from 2000 to 2010. This was a tough time period for QQQ. So if you invest right before a recession, it's possible that a high growth ETF like QQQ may underperform for a period of time relative to something like DIA. Let's take a closer look. Here's the first decade of the 2000s up close. $1 million investment, all three ETFs. We're charting total return, dividends are reinvested in all these illustrations. Here's the 01 recession. All of the ETFs go down, but QQQ really took a beating. 10 years later, your initial $1 million position is now only $506,000. DIA, on the other hand, was positive at 1.12 million, and SPY was still 10% down, roughly $903,000. This was a tough time period. You had the recession of 2008 and the recession of 01, and during this environment, DIA was in the lead. Investing $1 million in these ETFs after a recession produces very different results. We're looking at a $1 million investment made January 1, 2004. Now remember, 2000, 2001, and 2002, we had three sequential negative years for the S&P 500. By 2004, stocks were really cheap. So that $1 million put to work in January of 04 is now 19.9 million in QQQ. Look at the divergence that QQQ has between SPY at 9.2 million and DIA at only 7.4 million. Buying stocks cheap, especially growth stocks, after a recession can produce great long-term results. If you invested your money right before the 2008 recession, January 1, 2008, today you'd have 14.1 million in QQQ, 6.5 million in SPY, 5.3 million in DIA. If you had invested your $1 million in these ETFs in January of 09, close to the end of the recession, look where you'd be today. 24.2 million in QQQ. You rode the rocket ship. 10.3 million in SPY, DIA 7.9 million. This has been a tremendous environment for growth stocks. Clearly, growth stocks in particular were very cheap by 2009. If you put your $1 million to work in January of 2022 before the market sell-off, today you'd have 1.6 million in QQQ out ahead, 1.5 million in SPY, 1.4 million in DIA. Notice that during the downturn, QQQ was losing the most, but the situation is reversed and now QQQ is back in the lead. During the downturn, DIA lost less, but as time has gone on, it's now lagging. If you had good market timing, put your money to work in January of 23, QQQ has made a lot more money for you than SPY or DIA. QQQ at 2.38 million, SPY at 1.85, DIA at 1.51. The charts paint a clear picture. The best time to buy QQQ or SPY is after a recession and stock market crash. In past rebounds, high growth ETFs like QQQ and SPY have historically outperformed DIA. Market timing will have an influence on your long-term returns. Buying a high-growth ETF like QQQ in the early 2000s, when stock PE ratios were sky high, like now, resulted in losses for over a decade before you broke even and then eventually caught up with and passed DIA. Given how high PE ratios are at the present, the returns for QQQ may not be as strong as they have been in recent years. If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content and you want to see more of it, check out the HighPass Asset Management channel, where we have lots of educational videos on retirement planning, taxation, investing, and more. I hope this video was helpful, gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.